This is why debt makes your real estate investment way better. Peter here from Landlocked Lending. Let's get right to it. So I'm taking a look at a very simple example. You purchased a property for $200,000 and your LTV is 75%. That means you put down $50,000 for this property. Interest rate is 6%, amortizing for 30 years. Let's take a look at the wealth chart here. So under this very common scenario here, your total gross return over the course of 20 years, assuming that you sell it at some point, the breakdown is as expected, appreciation being a big chunk of it. You pay down principal, and your IRR, your internal rate of return, is 8.6% year over year, which is pretty good. I actually kept the cash flow very small, so it's actually not as great as it can be. I made some assumptions such as no rent growth, no expense growth. So I wanted to show you what happens if you don't even take any leverage. First of all, you're going to see the IRR drop, and I'll explain why right now. So right now you saw the internal rate of return drop all the way to 7.1%. It looks like you made a bunch of money, but remember, you put down $200,000 into this, and over the course of 20 years, you get $394,000 back. But before, you only put down $50,000, and I think the number was something like almost $300,000. So think about it. Which one is actually better in the long run? That's why debt is actually critical for making your real estate investment actually truly better than a passive stock market investment.